Every finance guru on the internet will tell you that mathematically, lump sum investing beats dollar cost averaging 66% of the time. They are technically right, but they never show you what happens during the other 34% of the time. Welcome to Syntax Finance. Today we are running a stress test. The years 2000 to 2010 are known as the lost decade in the stock market. If you invested at the peak of the dot-com bubble, it took you a full decade just to break even, surviving 2 historical crashes along the way. We are going to write a Python script to backtest exactly what happens to a $120,000 portfolio when it gets hit by sequence of returns risk. We'll compare a day one lump sum against a strict $1,000 a month dollar cost averaging algorithm. Let's look at the data. First, we pull the historical data for the SPY ETF. Notice we are using the adjusted close. If you build a backtest that spans a decade and you ignore dividend reinvestment, your math is broken. We use the adjusted close to account for total return. Here is scenario A, the windfall. You inherit $120,000 and deploy it all on January 1, 2000. By October 2002, your portfolio has been slashed to roughly $70,000. You have lost $50,000 to the dot-com bust. It takes you 5 agonizing years just to recover your initial capital by late 2007. And then, the global financial crisis hits. Your portfolio is cut in half again. The math here is brutal. This is sequence of returns risk, the danger of a market crash happening early in your investment lifecycle. Let's see if dollar cost averaging actually fixes this. Let's head back to the logic. In scenario B, we take that same $120,000, but we keep it in cash. We program an algorithm to deploy exactly $1,000 on the first trading day of every month for 120 months. Visually, the blue DCA line looks like a miracle. While the lump sum investor is having a heart attack in 2002 and 2008, the DCA investor barely feels it. By buying mechanically through the bottoms, they lower their average cost basis. But here is where 99% of finance channels lie to you. Dollar cost averaging did not magically beat the market here. The only reason this blue line is so stable is because of a massive mathematical flaw called cash drag. In year 1, our DCA investor only has $12,000 in the market. They have $108,000 sitting in cold hard cash doing nothing. Cash has a volatility of 0. DCA only looks safer because it is a cash allocation strategy masquerading as an equity strategy. In a bull market, this portfolio gets absolutely crushed. So, what is the objective logic we can extract from this data? If you are investing from a paycheck, DCA is a mechanical necessity. Automate it and ignore the noise. If you have a windfall, lump sum is mathematically optimal, but only if you have the stomach for a 50% drop. If you don't, DCA is your insurance policy. Don't trust my math? Verify it yourself. The complete Python script and datasets are open source. Link in the description. Subscribe for more financial systems analysis. See you in the next build.